Hello there, my friends. Chris Marcus here with you on the Miles Franklin channel on Wednesday, November 14th. Excited to have a new guest on the show who is Jordan Roy-Byrne of the Daily Gold. And in particular, we've talked a lot about the fundamental aspects of the gold market, although Jordan digs into the technicals a lot as well. So excited to have him on. And Jordan of the Daily Gold, how is everything going, and how is life following the gold market today?
Well, thanks for having me on, Chris. The gold market, it's been difficult and challenging, although I've kind of had my opinion and my framework for what I'm looking for, something new that I developed after gold failed to break out this year. So the gold market, at least it's been acting for the most part as I've been expecting. It doesn't always happen that way, but I feel pretty good about it. I still see weakness coming ahead, which I know we'll talk more about. But at some point in 2019, I think gold is setting up to begin another potentially very, very positive run to the upside.
Yeah, certainly a lot of us have been waiting for that. So by all means, if you could dig more into what you're seeing and how you come to that view, I'd love to hear what you're looking at these days.
Well, so technically gold failed to break out earlier this year, and silver and the gold stocks were lagging at the time when gold rallied back up to 1350, 1360 and was trying to break out. So given that gold failed to break out, or I should say, given how silver and the gold stocks were performing, they were so much weaker than gold in 2017 that it wasn't a surprise that gold failed to break out. Although it did, it looked like it was going to. So nevertheless, gold has obviously declined. Silver and the gold stocks have been hit really hard. And so technically there's nothing positive going on. The sector's in a clear downtrend. And on the fundamental side, gold is driven for the most part by real interest rates. And too many people in this market, they tend to focus on things that really don't matter. They talk about, well, the supply coming from mines and Chinese demand and, the physical market being really hot. And none of those things just really matter. I know some people are going to take a lot of issue with that, but the reality is, looking back throughout history, at least over the past 50, 70 years or so, gold performs best when real interest rates are declining, or especially when real interest rates are negative, because gold is a currency and it competes with the dollar and other currencies. And if you can earn a real rate of return on your money, putting it in the bank or a CD or a bond, then there's no need to have gold. However, if that rate of real return that you could earn, if that's declining or it's negative, then that's bad. Then you don't want to hold your money in that currency. You want to look for alternatives like gold and silver. And so what matters is, where short-term interest rates are going and where's the direction of inflation. And even though inflation has been ticking up, the Fed has been raising rates. So the direction of real rates, it's kind of been stable to rising over the past year or so. And so that hasn't supported gold. So fundamentally, I looked at the last 60 years of data for the gold stocks, and I was just curious, what happens when the Fed changes policy? Well, it turns out that I looked at 12 different times the Fed stopped hiking rates over the last 60 years. And in 10 of those times, the gold stocks, from that point forward, they had an average run of 185%. And I think the minimum out of those 10 was something like 55%. And now it's not true that, it's not always true that when the Fed stops hiking, that gold stocks are going to go on this massive run. You have to look at the context. So it's not always true, but for the most part, it is true. And looking at the context, I'm really confident that we'll see a bottom in this sector when the Fed stops hiking rates. And the time for when the move begins, looking at all the data, it's about an average of 1 month after the Fed stops, or a median of 2 months after. So the real question that we have to ask ourselves is when is going to be the Fed's last rate hike? Because that is going to be around the time that we see a bottom in the sector. You know, maybe the bottom is going to happen that week. Maybe it's going to happen a month or 2 or 3 months after. We don't know exactly when, but we know that we're going to be close to a major bottom when the Fed stops hiking. I think that will be sometime next year, but that's just a guess. And that's how I see things right now. And, you know, obviously when the stock market rolls over, the economy gets really weak, like it's going to be in a recession, that is going to be when the Fed stops hiking and changes policy. So it's dependent on the economy and the stock market. And so not immediately, but ultimately when we see more weakness in the economy and the stock market, that will be a major catalyst for precious metals. But it's not quite yet. I still think they can probably hike 1 or 2 more times before that happens, but we'll see. So that's basically my framework and what I'm really looking at over the months ahead.
Yeah, and it's fascinating you mentioned that, Jordan. I know you also just published a report called 5 Things That Precede Major Bottoms in Gold, which we can also dig into. Although just to stick with the Fed for a minute and the interest rates, where, like you mentioned, the Fed is raising rates depending on which inflation numbers one uses. Some feel that the real interest rate is negative or that it will become negative. I guess if you could touch a little more on, you talked about expecting maybe 2 more hikes, but what are you thinking in terms of where that real rate is and how that would factor in, and perhaps, you know, maybe over the next year, if you want to touch a little more on what you see the Fed doing, or if you think that we are reaching that point of weakness yet?
Okay, well, yeah, that's a good question. As far as real rates, there's many different ways you can look at them. If you look at the real TIPS yield, which is kind of a market calculation, I don't always look at that, but you can get that data if you go on the U.S. Treasury website. You can just type in, you know, real 5-year yield or real yields Treasury. So that's kind of the market calculation for real interest rates, and that has been, at least until a couple months ago, that was screaming higher. So the market was pricing in, or at least calculating or forecasting, much stronger real interest rates than what's shown by a simple calculation. I think the simple calculation is the most accurate, and that's just looking at the CPI, and then whatever interest rate you're using, if it's the Fed funds rate or the 5-year yield. So I like to look at that, but the issue with that is it's lagging. So you're looking at, you know, economic data as a lagging indicator. But nevertheless, but to go to what you said about the CPI and the inflation statistics, it is true that the data is questionable. However, if you look at shadow stats, the slope and the direction, the trend of inflation tends to be the same, like with shadow stats versus the CPI. So, and that's really what matters. It's not the absolute level that matters with real interest rates. It's, is it trending up or down? And so from 2011 to 2015, real interest rates, even though in 2011 they were so negative, they were rising. So they got they became less negative and then became closer to zero. So that trend, the fact that real interest rates were rising, even though they were negative, and that was true whether you looked at the CPI or shadow stats. That was a negative fundamental development, and that's also what we saw in 2017 and into 2018. Now, 2016 real interest rates, they went down big, so that was positive for precious metals. So that's why I don't concern myself with the shadow stats and alternative inflation calculations, because they're going to show the same trend as the CPI. So it's really, and it's not the absolute level, it's really the trend that matters. And so looking forward, you know, we could be seeing a real major, or at least in the last couple of years, you know, a major low in inflation and bond yields. And I think when we get to the next economic cycle, inflation will be bottoming from a higher level than what we've seen recently as far as the trough of the next recession. So we get into the next expansion, long-term interest rates are probably going to rise quite a bit alongside inflation. And if you look at the Fed funds rate, we're at 225 now, and I think the Fed wants to get up to 3%. Right. But if they start by the end of next year, 2020, if they start cutting and inflation doesn't go down that much or it's stable, that's really a huge fundamental catalyst for precious metals. So the fundamentals are not quite bullish right now, but at some point next year, I think fundamentals are going to trough and turn up. As the first leg in that is the Fed stopping their hikes. So when you see short-term rates peak, and this is something with we can also look at with long-term bond yields, like the 10-year, for example. Mm-hmm. It has broken out to do multi-year highs, but I'm not sure if that's going to sustain itself. I think what we can see with long-term rates is they actually come down over the next year or two and form a higher low, and it's really the next economic cycle when we see long-term yields rise, and they continue to rise for several years. So I think the strength that we've seen in long-term rates, I think it's temporary now, and it'll probably come down along with the stock market and the economy softening. I mean, we've seen this massive decline in oil, so there's many factors at play here, so yeah, it's really the trend. It's really the trend of real interest rates that's important, and fundamentals for gold are not quite bullish yet, but I mean, they will turn bullish at some point next year. And the very first step in that will be, I think, when the Fed stops hiking.
Yeah, and certainly going to be, obviously every year with the Fed is interesting to follow, though certainly, as you point out, the next year, given everything that's happened over the past decade, will be fascinating to watch to see how the Fed responds. Although in terms of some of the technicals, and one thing I've really been looking forward to asking you, I'm sure you hear a lot of the commentary about the COT report, which shows that a lot of the banks that had been short a lot of the contracts appears as if they have unwound that position to a great degree. Some suggesting that they have been long, although it appears to change a little bit in recent weeks. Curious if you get into that at all and have any comment on just the positioning between the hedge funds and the banks and how you're seeing that.
Well, I like to look at just the overall net speculative position, so I don't really divide it up. I just look at what the commercials are doing, and then everybody else I just put in the speculative category, and then I measure the net speculative position against open interest, because that gives me anyone who does that, it gives you a consistent look since 1986 when the data starts for gold and silver. And I've done a few videos on this, and I've written an article or two about this in the last couple of years. Conventional COT analysis, it doesn't always work at turning points, and so people have been getting excited. They've been getting excited in recent months about, the sentiment, look at the COT, the speculators are net, it's true, the speculators did become net short gold and silver, for the first time, at least gold since 2001, and the first time ever for silver. And again, this data goes back to 1986, but the problem is a lot of people, they're number one, they're looking at this data and they're only looking at the last 16 or 17 years. They're saying, wow, this is super bullish. But they're not looking at what happened in the 80s and the 90s. And what happened in the 80s and the 90s is gold was having a tough time, but the net speculative position was negative so often. And recently, I calculate this as a percentage, and recently we were at, I think, minus 6% for gold. And if you look at the 80s and the 90s, minus 20 and minus 30% were really like the most negative points. And what happened is we would get to that point, and then gold would rally for a little bit, and then it would, go lower and make a lower low again. So people are looking at this stuff only in the context of the last 15, 16 years. They're not considering what happened in the 80s and the 90s. And that tells us that gold is in a downtrend. It's in a serious downtrend. And so there's no, I mean, there's obviously a limit, but we're not at the limit right now as far as how much more, how much more short the speculators can get. Again, I think recently we're like -6, -7%, which was at a 17-year low, which, yes, for the time being, yeah, that might be bullish for the next month or two. But if we're looking at the last 30, 35 years, this reading can go down to -20, -30%. I mean, it can get a lot more. It can get a lot more negative. So people have to be very careful with following this conventional analysis of the COT, because in recent months it's been deadly. There were people who were looking at this and they were saying, this is so bullish that gold is going to go to 1350 or it's going to go to 1450. But they didn't realize that for that to actually happen, speculators would have to just buy and push up the position super high. But you know what? The market trend is down. Speculators are going to short. They're only going to push up the price when the market's strong and it's rising. So there's a lot of, that's how I look at it. I'm not an expert on like what the banks are doing and all those types of things, but I just want to tell the audience that you have to be very careful following conventional COT analysis, because that has been very costly for people, especially in the last 3 or 6 months.
Yeah, I think that's well said, because it can be a tool, but like you said, it's not really a traffic light where it's green, red, or yellow, and things are quite as straightforward. Jordan, I know you just published a report, like I mentioned before, 5 things that precede major bottoms in gold. And you also have a book, The Coming Renewal of Gold's Secular Bull Markets. Just in wrapping up, if there's anything you'd like to share about either of those, and also how people can find you and get more information.
Well, they can find all my work at thedailygold.com. And actually, I'm updating my book right now. So I'm really excited to put out, hopefully in January, put out a new copy, which should cover, all the research and things that I've done in recent years. So I'm really excited to put that out, and that'll give my forecast for, what could potentially happen over the next couple of years and kind of where we are now. Why did gold go down? Why is gold struggling here? What needs to change for gold to go up? And so I'm really excited to put that out, hopefully in January, and people can find all my work at thedailygold.com.
And we will have a link to that. Again, great to catch up with you, get into the gold market a bit more. Obviously, a lot of interesting things happening, although I appreciate you being a resource and sharing what you're seeing in the market. So with that said, thanks again for joining me, and we'll look forward to checking in with you again soon.
Thanks so much for having me.